In this lecture we will talk about the assumptions of each one of the 4 valuation methods that we mentioned in the previous lesson. Starting with the discounted cash flow method, we assume that the value of our company derives from its ability to generate free cash flows in the future. It is therefore evident that this method highly depends on the predictions about the future cash flows, as well as the selection of the discount rate that will be used for discounting the cash flows from the future, back to the date of valuation. Next, we have the dividend discount method, which works on the premise that the value of the company stems from its ability to distribute dividends in the future. It highly depends on the size and future growth of the dividends, as well as the discount rate that will be used for discounting the dividends. Then, we have the comparable trading multiples method, which assumes that similar companies, with similar size, operating in the same industry, should trade at similar valuation multiples. In other words, our company should be worth based on valuation multiples of other similar listed companies. The most commonly used multiples are the enterprise value to sales, the enterprise value to EBITDA, the enterprise value to EBIT, the price to earnings, and the price to book value of equity. Lastly, precedent transaction multiples method assumes that prices paid for similar companies, with similar size, operating in the same industry, should yield similar valuation multiples. In other words, our company should be worth based on valuation multiples of transactions of similar companies. Here, we use the same valuation multiples as in the previous valuation method. Thanks for watching.